Hello everyone. My name is Kamal Manocha. I represent PMSAF World. Every Friday we do webinar with one of the industry thought leaders, and all thought leaders who are fund managers are first investors themselves, and that's what we like about some of these boutique fund managers. Markets at all-time highs. Whenever market reaches or attains an all-time high level, it creates a cheer for investor, also creates a fear for investor. And this webinar is all about understanding what lies between cheer and fear. And obviously, we'll try to objectify this. We'll try to understand this, more from the point of view of statistics, data, learnings, as well as wisdom of, the fund manager that we have today as a speaker, who brings with him more than 2 decades of experience. Mr. Vikas Khemani needs no introduction. He has built Carnelian Asset Advisors, I think, during some of the most tough times, and has actually done really well across the two PMSs and one AIF. Very focused, and few product strategy that he has been following. So obviously, we have been doing webinars with some of the thought leaders in September, because we understand September as a month, as per my experience of almost 2 decades, tells me is always a month which sees a lot of directional moves. And this year also we have seen, September has shown all-time highs on small caps, all-time highs on Nifty, and hence it's important to discover what lies between cheer and fear. And that's where, last week on Friday, we did webinar with Mr. Pankaj Morarka. We thought this Friday we should do the same with Mr. Vikas Khemani. And then subsequently 2 Fridays are also planned like that with thought leaders. So welcome, Vikas, to this, webinar. I have already set the context for you. All of us understand markets are at all-time high. There is a fear as well as cheer. But what are your views, on this opening statement to begin with? How do you see the current times and the way forward?
Kamal, thank you very much for having me on this esteemed panel. And first of all, I must compliment you for putting together such a great platform. I have followed you, over the years, and you have created truly an invaluable platform which adds value to the participants, clients, and markets in general. You always bring thought-provoking, sessions and discussions. So nobody knows future for sure, but these kind of discussions only help people to gain understanding from different thought processes. So compliments to you. Again, coming to your point about, as you rightly said, that we all move between cheer and fear, or greed or fear. Markets are made of that, and I think so far whatever journey we have seen up till 20,000 of Nifty is full of those moments of cheer and fear. And every time the index hits new high, all of us sit back and again it brings cheer and fear, as you rightly said. But go back and see, Nifty has hit all-time high many times in last 30 years of history, because it's a journey. And I believe that Nifty is nothing but reflection of how Indian economy is progressing. We all know that post 1991 and thereafter, the many catalysts which have come, Indian economy has progressed, and it is only reflection of Indian economy which has gone from $250 billion, or less than that for that matter, to $3.5 trillion. So that is reflecting in our journey of wealth creation in form of market cap. So the way I see is that अभी तो ये जो हमने देखा है वो पिक्चर शुरू हुई है. The big journey is yet to come, because India has a massive tailwind and massive future ahead of us. Like, we are, politically speaking, our Prime Minister has given the call from Amrit Kal, which is basically how do we become a developed nation over next 25 years. And as and when this journey happens, massive amount of wealth will be created. As our economy goes from $3.5 trillion to 10 trillion and then 15 trillion, this numbers will keep adding and the new highs will keep happening. It is in that journey, in that direction. And people who understand equity markets and equity investing, will neither get, very worried when markets fall, or not will get very excited when markets rise, because this journey is very clear that where we are going. And if you ask me, anybody who's been doing investing into markets, they know that this journey is destined to, given lot of structural growth drivers India has, whether our demography set up, where there are democracy set up, the way Indian entrepreneurship is set up. I think all are, and fortunately, post pandemic, post COVID, and post 2014, we have been on a transformative journey. But post pandemic, it has been even an accelerated transformative journey. So today we are in one of those rare phases where all cylinders are firing, and when all cylinders fire, the amplifying effect is always more than sum total. And whenever this kind of scenario happens, it is bound to create a massive amount of wealth. And so I am not at all in the camp that markets are overvalued. I am not at all in the camp that markets are frothy. Of course, in every market there are pockets of froth, there are pockets of euphoria. That's the nature of the markets. There will be in a pessimism market, there are always huge amount of pessimism. Even good quality company trades badly. In good markets, poor quality company starts trading crazily. So that's the nature of the market. The sensible investors do avoid them. Sensible investors take a very long term view and continues focusing on sensible, solid investing. And that is what all of us should try to do. Wealth creation journey is surely ahead of us. I want to very clearly state on your platform that there is no need to worry. The massive wealth creation journey is ahead of us. That does not mean markets will not correct. That does not mean that markets will not be volatile. Like, I will probably play a small trailer in front of you that I remember distinctly. In 2002, Nifty was 800 points. Today, sitting 20 years down the line or 21 years down the line, it is almost 22 times, right? Or 22 times, which is CAGR of 17-18%. Now, in this period, think about it. Post Ketan Parekh scam, we came out. Then we had, UPA 1 government came, UPA 2 came, global financial crisis happened, coal scam, 3G scam. We became part of Fragile 5. We had to do emergency bonds. Then, GST happened, demonetization happened, pandemic happened, Ukraine war happened. So I can only tell you one thing. I don't know any investing year of my career where there were no worries around, no potential risk factors around. Potential risk factors, potential worries are always around. But despite all the massive, man-made human crisis, all kind of crisis, economic crisis, India has delivered. India has compounded at 17-18% CAGR over last 20-21 years. I see no reason why this journey should be any worse over next 20 years. It could be even better, but even if it were to replicate, you can imagine 20 times of Nifty from here, and now you can do your numbers. So that is how at least I see.
Sure, because I think a thought leader like you can obviously give a big picture, and this big picture is something that has attracted the audience today also to listen to you. And all our clients and all the investors that you and I cater to understand, and are convinced with big picture, and reminding them on the big picture obviously is quite comforting. However, the question that these astute investors always have on mind, that you as a fund manager, when you are managing your equity portfolios for your clients today at these levels, at these valuations, where obviously certain things may look frothy, certain things may look still attractive. There are macro events around us. Micro picture absolutely looks to be good and robust, but valuations also play a role. So what is it that that you as a fund manager are kind of seeing ahead? When we want to hear from you, we want to hear that analytic context also beyond the big picture, maybe more minutely over next 3 years. What is it that you see happening, and your lens shows us how to kind of advise our clients, and that will give perspective to investors as well.
Sure. So, first of all, let me address this question. I think I hear very often, and I think partly you are also touching upon that, markets are very expensive, right? If you can get that slide there, I want to show one slide during the conversation. If it's there, let me know. But I will tell you what slide to put in. But let me first give you context. See, how does valuation get determined? Valuation of asset class, any asset class for that matter, is function of three things. What is the return an asset class is generating? Second one, what is the growth in that return or earnings growth, incremental growth in that return. So return is ROE or of that particular asset class. Growth in that ROA. And third is the discounting factor. Discounting factor in turn is combination of two things: interest rate, risk-free interest rates, and risk premium. Okay. Now let us understand what is happening on each of these three component of the valuation, right? Because that based on that only you can determine whether asset is highly valued or poorly valued or fairly valued. Now, India's ROE is, the best in all the emerging markets at a closer to 16% around there, 16.5% around there. It is, best in the historical context. So we are sitting on a high return profile of the market, and it is only looking to get better. It is not looking to get worse. Secondly, the earnings growth or returns growth in the ROE. Now, today, as we are sitting, our earnings are expected to grow anywhere between 15 to 18%, right? Pessimist scenario, you can be 15%, optimist scenario can be 18%. But on an average, this is a broader range which we are expected to grow. Today, if you look at all cylinders are firing, our banking is in best shape ever. Automobiles have come out of a deep cycle downturn. IT is doing very well and looking to do very well. Telecom is doing very well. Oil and gas is doing very well. Consumer is reasonably well placed. So, infrastructure, we know the massive amount of wealth is being spent across roads, railways, airports, ports, everywhere, right? So, there is a very well diversified earnings growth. It is not dependent on a particular sector, unlike many times in the past, or unlike in many other emerging markets. So this kind of well-balanced growth gives us the confidence that it will be sustainable over a long period of time. So you have not only a good growth, but a sustainable and a diversified growth. So to that extent, growth in the risk goes down. So our growth profile is looking very good. Third part is the risk discounting factor, which is risk-free rate and risk premium, combination of that. So India's risk-free rate, to look in global context, we are the cheapest ever. The difference between 10-year GSEC of India and 10-year T-bill paper of US is lowest ever at 130-140 basis point. Historically, it was like 5%, 4%, or 6%. It is one of the lowest ever. It means our cost of capital in the global context has come down significantly. Today, no Indian company wants to borrow abroad because it is expensive borrowing abroad than cheaper. Second component of this is risk premium. Risk premium is function of how much risk a country carries, so that it should, higher the risk premium, hence the discounting factor goes up and valuations go down. Lower the risk, lower risk premium, discounting factor goes down, valuation comes down. So if you just take the combination of this, higher the ROE, higher the growth, lower the interest rates, higher the valuation. This is a very simple, Now I will give you a context. Everything else remaining same, a 2% drop in the discounting factor changes the equity valuation by 35%. Meaning, if earlier, let us say your discounting factor was 8% risk-free premium and 5% risk premium, 13% if you're discounting your cash flows, and let us say the P was coming 20 times, I'm just making up some number. If that 13% comes down to 11%, combination of risk-free and risk premium, the equity valuation can go up from 20 times P to 27 times P. So when I'm saying that ROE, earning growth and interest rates all are favoring towards positivity, how come valuation will be cheaper? Valuation will not be cheaper. And fortunately, if you see a slide which is there on we are not very far off. There is a slide where I'm showing the historical. If you can just open up the slide, it shows that we are at if you see this slide, we are at not very, we are closer to the 10-year valuation. We are trading 18 times 25 price to earning, right? And in terms of compared to other emerging market, we are not very significantly. We always traded at a premium. We will continue to trade at a premium. So my point of view is that we are not expensive at all. We are not cheap. We are not expensive. We are fairly traded. In fact, I will be worried despite such a macro environment which is good if we were to trade cheap. Because in a good things can't be cheap. If good things are cheap, then there's something wrong, essentially. So according to me, one should not worry about the expensiveness of the market. Of course, there are pockets, like railways, defense, and many more, where exuberance is built. We can avoid them. There's nothing, nobody's asking us to go and invest where, but because there are exuberance in pockets of overvaluation in certain aspect, does not mean the overall market is bad. Markets are right now, earnings growth is solid, liquidity continues to remain solid. When both things are there, liquidity determines market in the shorter term, earnings determine market in the medium to the long term. Today, fortunately, we are in one of the scenario, we are in the environment where both earnings as well as liquidity continues to remain very robust. Liquidity both from domestic as well as international investors. So I continue to believe that this is a good scenario. When I'm saying this does not mean that there's no risk. There is no risk around the corner. Risk is always around the corner. One should be conscious of the risk. Our biggest risk, according to me, is right now coming from two factors. In the shorter term, it is coming from the rising oil prices. If, let's say, they continue to rise, we will have a short-term challenges. And second, today, the global macros are slightly precariously placed, especially US, where interest rates are going up and still, employment is holding up and Fed is trying to slow down the economy and still not slowing down. And markets are, reasonably high. So this kind of setup is a, slightly worrisome setup. I don't know when some kind of pain can come from there. I know one thing for sure, those kind of pains come always suddenly, like we saw SVB crisis happening some time ago, and markets kind of panicked in short term, but we know that how markets recovered back. So point I'm trying to tell you, those kind of risks are always around the corner. We cannot predict when they will happen, but they will happen. And only thing is we have to be prepared to handle those kind of risks. We cannot not invest expecting those risks. Our model in investing and portfolio has to be robust enough, our strategy has to be robust enough to handle that kind of risk and volatility.
Sure, Vikas. So one of the statements that I saw was mentioned on that slide where we are trying to show that valuations of equity markets in India are fair. You have mentioned that India has turned defensive and is a low beta market now. Can you please explain that statement?
So again, like I was saying, very simple. Our earning volatility, what is beta? Beta is volatility, right? Because we have such a well diversified earnings growth, lot of factors are firing. If one slows down, still India does not go away. When you have typically your, let's say, China model, the growth is a lot dependent on exports. Exports slowing down, economy has come to squeezing hold. Brazil, commodity driven economy, right? India is one economy which is driven by investment cycle, which is very, very robust. Like I was saying, both in industrials as well as infrastructure. It is driven by the export cycle. Today, after long, our exports are picking up, and it's driven by a consumption cycle because we are one of the youngest growing population and working class population. So we have all three engines of economy firing. It is not dependent on one particular engine. It is all contributing. And when you have this, on other cut to look at it, that we have services doing well, we have industrial doing well, we have agriculture doing well. So we have reasonably good balance across all component of economic growth. When you have that, you have less volatility. And secondly, from a liquidity standpoint of view, today our current account deficit is well managed. We have a large forex reserve, and our fiscal deficit is very well managed. So you have also huge comfort there. India is the only country post global financial crisis which has reduced its debt to GDP ratio. Every other country has gone up their debt to GDP ratio by 2x, 3x. So our balance sheets are better, our fiscal deficit is better, current account deficit is better, our growth drivers are better. So both on a growth driver and liquidity we are well balanced. When you have this kind of well balanced growth, obviously volatility is bound to be less.
Sure, I think this is well addressed. Subsequently, the question that comes to my mind is that we have also seen over last 2 decades, markets always show some kind of trend, and there are many new age fund managers who have started to now follow those trends and many, fund managers coming from IT background have derived softwares which try to kind of, study these trends, whereby they say that at times market is value conscious, at times market turns growth conscious. Till maybe 2021, maybe interest rates are very low, markets are valuation ignorant because there was cheap money available, and we could see many stocks rising to even PE of 100. And in those days, we saw the concept of consistent compounders. Many growth stocks and many stocks actually went up and gave very good returns. We were talking about businesses growing uh, maybe at 15%, but their stock price is growing at even 20%. That happened almost in last decade because interest rates were low. 2022 onwards, when we saw interest rates went up 13 times, market turned value conscious. And over last 1.5 years, 18 months, we have seen the entire value side of market, be it PSUs, be it infrastructure, be it real estate, be it manufacturing, all this side which was actually trailing at lower PE and was actually not touched by many star fund managers. Many fund managers used to say, we don't touch this. This is all dirty. We only touch moated businesses, oligopolistic businesses, monopolistic businesses. Now those businesses are like, not rising, but these businesses gave very good returns. And hence the question mark in the mind of investors today, because the overall allocation of investors today is such that most investors have maximum allocations towards large caps, and within those large caps, expensive large caps, and a very low allocation towards actually mid and small caps. Your organization has actually created a success in maybe identifying that trend, or maybe you were lucky that you came at a time where this change was happening and you were value conscious, and your portfolios hence have done really well. And hence this overall question to you, to kind of give your perspective on this context. First of all, do you believe that yes, trends do kind of exist, and is this trend of change from growth to value here to survive for long, or we'll soon see the kind of change back to growth? Because as you yourself mentioned that in next one year you're projecting interest rates to again go down, and hence this trend could change.
So I think, again, I'm sure there are some macro trends which do play out, from time to time. In a cheap money context, of course, growth ends up taking more value and front stage. And when the cost of money goes up, hard assets and physical assets ends up being more valued, right? Because you take more money to put up the same kind of assets, right? So yeah, I don't know if you remember, but in 2000 last year exactly, about in January 2022, we had launched a new strategy called yield and growth strategy, where our idea was to generate 5 to 6% dividend yield and 10 to 12% earning growth, and invest into companies which are benefiting from the inflation cycle, and which have physical assets and which will get valued because the replacement cost goes up as the physical assets value go up, right? So we launched that strategy, and that strategy was has delivered in last 1.5 years almost absolute basis about 55%, 50% plus return versus market of about 7-8% return, right? So you obviously take advantage of these kind of situations as and when do appear. But my own view is that from a longer term perspective, and I think that's the game all of us are in, that how do we compound our capital over 5, 10, 15, 20 years. One thing I've learned is that growth at a reasonable price or quality at a reasonable price is what does very well. Essential part of, if you look at my framework of three components of the valuation, ROE, earnings growth, and discounting factor, all three suits very well in a context of if you buy a good quality company which can grow at a reasonable price, right? So our focus is to buy quality growth at a reasonable price all the time, right? Of course, the lens to look at growth, is always, because growth is future forward looking, right? And that is where you need to have little bit of connecting the dot perspective, that what is going to work and what is likely to work, and what sectors to bet on, and that becomes a little bit more required. And that is where I think people like professional managers like us do tend to play a role, and try to find out what all one should do it. So first of all, I would say growth is where money is made. So essentially, if I were to position my portfolio for a long time, growth is what we will look at, and growth at a reasonable price. We do not believe in growth at any price. That's the most stupid concept according to me. But growth at a reasonable price is what we believe, and that is what we at least that's what at least we subscribe to. And we've been constantly looking at investing ideas in that philosophy, and it has served very well. Like you said, all our funds over last 4 years have done well. I've been in the market for 25 years. I've made reasonably good amount of wealth, using the same framework. So I would assume that especially when the growth environment is looking good over next 10-15 years, why anything should change.
So one of the strategies that you had pioneered during COVID times, during the lockdown times, was a shift strategy, where your argument was that Indian economy is showing structural shift from being a services economy to also being a manufacturing economy, and this is a long-term trend, and hence you started raising money for your AIF also for a 7-year kind of horizon. So obviously that conveyed that it's a long-term trend, and over last 2 years after that, those funds were launched, performance has absolutely been very good. Obviously, because that was right timing to identify that shift happening. Now that shift has happened, or this is started, or this is partly done.
Sure. So you're right, Kamal, that when you big money is made, when you identify a trend, long-term trend, a decadal trend early on, and go and invest into good quality companies in those trends, or what's going to benefit from that trend. That's a secret source of making big, massive wealth, right? I mean, that's how. And as you rightly said, that we launched our shift strategy primarily focusing on manufacturing in August 2020 and started investing from October 2020, and that strategy has delivered almost 47% CAGR versus benchmark of 23%, right? Now many stocks we bought in that time have become 5x, 6x, and very often we get this question that अरे इतना तो चल गया अभी, now what next? Do you think it was over or going to play out? So here is the interesting take. First of all, I think whenever manufacturing, this kind of trend comes, they are decadal in nature. They are not short term, especially in manufacturing. By the time you start planning and start outsourcing and do anything, 2-3 years just go by, right? And then the real journey starts. So today, manufacturing has many legs. Number one leg is, if you see in last 10-15 years, India has been significantly underinvested into manufacturing and infrastructure investments, right? And today, government is rapidly, at a massive pace, pushing on, substituting imports. They are doing everything through their policy to make sure that we manufacture locally what we are importing. So we are focusing on Atmanirbhar Bharat, and government has a series of initiatives. Now these initiatives are not targeted 2 years, 3 years. They are targeted from a 10-20 year perspective, so that India's economy become less vulnerable. Number one, it's like similar to what 91-92 economic reform happened. The manufacturing reform is similar to that kind of reform. So if I were to look at the impact of that, will be outlasting over 10-20 years, right? So that is one. When banking sector was opened up, banking sector, of course, did very well in a couple of years, but it also did very well over a long period of time. So manufacturing has many legs. Number two, the shift from China plus one is a very big shift. Today, today also China commands very large share, almost 28-29% share in the global manufacturing. Today also most global companies outsource from China. The shift is happening, but these kind of shifts, you can't suddenly one day I will start manufacturing from India tomorrow. It takes a lot of planning, putting up capacity, approvals, audits, building capabilities, and then shift starts happening. China started building manufacturing practically in late 90s, and they started becoming leaders only towards 2010, 12, 13 period, right? Or 2005, then they started gaining pace. So same way, this whole shift from China to India or elsewhere has begun, and this is again a 5-10 year trend, which will sustain. So, and thirdly, I think India's own economic demand growth is also very good there. So if I'm replacing import substitution, I'm exporting more, and my own demand is growing. So if you see, and in this demand, what is happening? Our consumption demand is growing, plus our investment demand is growing. Investment in infrastructure, massive investment, ports, roads, railways, airports. This is growing at an unprecedented pace. So combination of all this will create this is a manufacturing as a decadal trend. So I would say, and whenever this kind of trend happens, if I were to repeat history, when the pharma trend came about, Sun Pharma went on to become from 1,000 crore market cap to 3 lakh crore market cap. L&T, in 2002 to 2008 cycle went from 10,000 crore market cap to I think almost 1,50,000 crore market cap. Thermex from 400 crore market cap to I think almost 10,000 crore market cap. So this kind of journey happens. So we are in that journey somewhere in first 2-3 years. It will play out over next 10 years. So there's a massive amount of wealth getting created. IT sector, we are in manufacturing where IT was in mid 90s or late 90s, where China was in 2005. So it's a very, very long way to go. I can only tell you one thing. Every day I get surprised when we meet companies that, oh, ये भी हो सकता है, ये भी हो रहा है. We get surprised. Despite being in this game so early, we get surprised that, oh, this potential is also there. So in such an interconnected global world where India is such an entrepreneurial country, many new opportunities are opening up. Like I'm telling you, we just invested into India's first defense bullet manufacturing company. And I get surprised that we have started exporting bullets, which we were importing. Now, potentially that company can become 20x also. So all those things can, or maybe 40x also, because it's just the beginning of a very, very large trend. So I think India is going to see a massive, massive, opportunity of wealth creation in the manufacturing space. We should not make the mistake of undermining, saying, "अरे ये तो बहुत हो गया है, अभी और कितना?" It is still long way to go.
My endeavor, is to try and address all those questions which come to investors' mind when they will see, your strategy, maybe a shift strategy, which is one of the best strategies that you have, and it is a human mind which always gets biased because of recency bias, and since numbers are very good, obviously, we need to kind of address the subsequent question that we also know that small caps and mid caps work in cycles, and if one gets entrapped or one invests in the wrong side of the cycle, it takes a lot of time for one to actually even recover principal. And shift strategy has 80% allocation towards mid and small caps, and maybe I think 65% is into small caps and 15% towards mid caps. So from that point of view, while obviously we are trying to build a good logical argument in favor of manufacturing backed by a portfolio, which has given very significant alpha. So I wanted to address this aspect also, so that investors have a clear understanding of your conviction in this regards also. Obviously, we understand that nobody can time the market, and we understand every investor has to take his own decision after understanding his own overall asset allocation, and no investment into a mid and small cap portfolio is to be done for a horizon of less than say 5 years. But obviously we know, next 5 years are a time which could be one of the best times for Indian economy, and within that manufacturing as a sector. But still the question needs to be addressed.
No, so I think Kamal, no doubt that we have seen a very sharp run up in small caps and mid cap. But also, if you see the context, last year we did see a beating down of the small caps and mid caps, right? So if I look at a 2-year time frame, small caps and mid caps have done reasonably all right, not excessively all right. But having said that, there is a sharp run up which has happened in the recent past, and one can take a cool off approach. Markets are never going to go one way in a hurry. But the point is, the big point I want to make: nobody puts money when markets are going down. When SVB crisis happened, I remember doing many seminars and many webinars and sessions on our platform also, that we don't think SVB crisis will have impact on India and one should invest money. And that time Nifty was 17,500. But go back and check how many people wanted to put money or did put money. Because investor psychology also, you get scared when things are bad. So, of course, to invest into 17,500 risk reward is screamingly in your favor versus 20,000, that you don't need too much brain to figure that out. But the unfortunate part is nobody puts money when markets are bad. And my point is that I am always very convinced that India is long-term story. It will do well. Risks are not very there. But if any global related reason issues when markets to get short-term this kind of thing, please do put money.
Absolutely. Investors need to base their confidence in the fund manager. They should understand that their area of ask has to be return, and risk is something that they need to believe, in fund manager. When fund manager is given money to manage, you have great experience, and obviously you are expected to manage risk well. And hence, in that context, I'm sure investors would want to ask this question, that today, if money is given to you for shift strategy, what is the kind of deployment strategy that you will follow in terms of maintaining beta, maintaining, the cash elements in the portfolio?
So we have a very simple strategy. It's not a very complex strategy. We have a portfolio which we run, and for every portfolio stocks, we have our comfort zone of buying price, and beyond that comfort zone, we don't buy. So let's say if you give me today 100 rupees, and if I have a 25 stocks portfolio, there will be 8-10 stocks which probably would have been out of our comfort zone. We'll buy stocks which are there in our comfort zone. We'll wait for to the right time to buy stocks which are not in our comfort zone. In case the stocks which are not in our comfort zone does not come down, then we replace with them over a period of time, as with the newer set of stocks. So we don't necessarily run the typical model portfolio approach. We will not buy stocks till the time we have comfort around business management and valuation. Sometimes, of course, it is very tricky decision to take, from a long-term perspective, when the company is trading well, but still you want to buy. Those are the very few exceptions we make. When one is not sure, you still want to buy the company, but it still is not coming down. But there are very few decisions. But generally speaking, we've been very conscious about deploying capital. Of late, we've been sitting, in last 1 month or so on 20% plus cash, 20-25% plus cash for the new money which we get. In some cases, even more, which we will deploy in times to come as and when we find the right opportunity.
Sure. It's been almost 5 years, Carnelian was born. It's kind of now more or less a known name because of its, performance, the kind of success it has attained, largely driven by your thought leadership. The question that, comes to my mind is that since, I have deep understanding and insight about this industry, and I know you come from Edelweiss, which is known for alternates, which is primarily a area which is of unlisted equities. We do equate listed equities also in alternates, but primarily it is unlisted equities. So now, after having attained good success in the listed space, when we know times ahead of us could be very interesting for unlisted equities also, and if interest rates were to fall, they will definitely create a lot of liquidity towards unlisted assets. And hence, how do you see the opportunity between listed versus unlisted? Because over the last 2 years, where listed equity markets have actually made again all-time high, but unlisted space seem to be struggling because obviously unlisted space requires larger money supply for it to drive, and money supply, the price for money supply is interest rates, and interest rates are high, which eventually should come down. So you, as a founder of Carnelian, given your history of coming from Edelweiss, having worked there for almost 2 decades, are you thinking of also launching a product in the unlisted space, or you want to stick to the listed space? And what are your views in this regards in terms of opportunity in front of investor to choose between listed and unlisted space?
So first of all, Kamal, I do believe that unlisted space is not the game for direct list investing, not the game for retail to do direct listing, and that is where we've seen, unfortunately, these days there are a lot of platforms who've been selling unlisted companies to retail investors. In my opinion, that is very dangerous because it's very hard to understand listed company, and on the top of it, you are investing into the unlisted company without any information. So I would always say people, stay away from those kind of temptations. There's enough and more money to be made from listed where at least you have information and all those things. Don't get into the temptation or marketing tactics of people. Again, it is not about listed or unlisted. It's about equity investing, according to me. As long as I find a good company, good business model at a reasonable valuation, makes no difference, right? So what we did in our manufacturing fund, which is an AIF, which we launched, up to 30% we do unlisted pre-IPO companies, where we meet these conditions. If we meet these conditions, we would invest. If we don't meet these conditions, we will not invest. We subject those investments to the same rigor process of evaluation like we do listed. So for us, listed or unlisted, the only difference is that in unlisted, you might not get liquidity when you want. Other than that, it makes no difference to us on any count. Reason why we do also unlisted is many times when there are, especially in things like manufacturing, where the new opportunities are coming about, you don't get them in the listed space. Like I was talking about, we made investment in a defense bullet company. Today, I don't have that in the listed space. So the only way to get to access to some emerging opportunity is unlisted space, and that is where we try to put our effort into. Otherwise, we don't.
Sure. So talking about risks, because as you said, risks always exist, and there is no time ever, in the history where we have seen there was no risk. One needs to understand and then carry that risk more confidently. So in that regards, you mentioned that one risk which lies in front of us is oil prices. I think investors have forgotten that risk. I do not see anybody talking about that risk. People talk about inflation, people talk about interest rates, people talk about geopolitical risk, people talk about elections risk, people talk about recession in US. Oil price is something which I think I am hearing after a very long period of time. But you mentioned that, so I need to understand that. What do you mean by oil prices risk, kind of an imminent risk in front of us?
No, so I think, see, oil prices have been steadily rising. It's gone to already 90 plus, and I mean, if it might go to 100 also. I mean, I'm not an oil expert, but I hear the noise or commentary around that it's looking firm and it's expected to go at least in the shorter term. One thing we know that it may not stay there for long, but at least even in the shorter term, it might create more pressure on the inflationary pressures, right? Because oil price goes into everything, right? And with the growth coming about, especially in the Indian context, the energy prices are going up also, and that is also part of a worry in the overall context. So I would say that that's the one part, because Indian economy is a fairly large importer of the oil. That has an impact also on everything. So that's the one part we have to be careful, worried about. I'm sure government is also focusing on or worrying about how to address that risk. But at least I can say energy price management, this government has been one of the best in terms of managing the impact of that on the economy. But having said that, if it is going overall up, there's very limited you can do much. You have to live with it. So to that extent, we might have some challenges in the shorter term. Yeah, so I would say that if that happens, one has to be careful.
Also mentioned that at present all guns are firing, and hence obviously this entire growth that we see in front of us is a very broad based growth. Within that, you mentioned auto sector has also recovered from kind of a slow phase, and we all know auto sector is going through transformation from older technology to EV. And since you have a manufacturing strategy, I'm sure auto is one sector which is nothing but manufacturing. So from that point of view, how does your research see particularly auto sector? We know when I talk about auto sector, names come to mind is like Maruti, Mahindra and Mahindra, and some of names like, and then obviously some of the auto ancillary names. But how do you see auto sector in terms of opportunity over the next 5 years in this context?
No, we are positive on the auto sector. After almost 2018 to 2022, there was little or no growth in the auto sector. In fact, there was a degrowth. But after long, we have seen auto numbers coming about. EV transition is also happening, so that is also driving growth. Infrastructure build-up, which is there, is driving growth. Consumption levels, income levels have gone up. That is driving growth. So auto sector is a good, robust sector. We've been playing through companies like Tata Motors, which is also a very large play on the EV. We've been playing through M&M, which is again a diversified play, and a large play on auto and farm equipment and tractors. So everybody has its own way of figuring. We are playing through some auto component companies which are more exposed towards EVs than the ICE. So we created our own little way of playing that out, and I think it's going to create a good opportunity in times to come. It's an interesting sector.
So, we are not expected to cover any stock specific questions. But if you allow, I want to cover one stock, which I see, some fund managers recently adding, and that is Bharti Airtel. This stock comes from infrastructure sector, and hence maybe you also have in your portfolio. If I was to see financials of this stock, talks about being part of a industry where kind of today we have a monopolistic structure. Maybe that is the reason this looks interesting. But if we see the valuations, if we see the growth, the ROE, it looks to be very I would say less attractive stock. How what is the difference in your lens versus my lens? When we see Bharti Airtel, I don't see that to be attractive, but I see heavy weights given to this stock. So it's like maybe ITC as a stock was like looking very dull for 10 years, and suddenly it went up. Is Bharti Airtel also at that inflection point?
So if you see in last 5 years, Bharti has gone up for almost from 300, 350 levels to 900 levels. And what has led to this is the consolidation in the industry. Very rarely you see this kind of industry in a duopoly kind of situation, or kind of almost duopoly kind of situation. And I think now the ARPUs have been going up, and this is the one business, one product which I think all of us can't get away. We will all have to consume. And if it is duopoly, it has also become price sensitive. Whether you are paying 100 rupees or 150 rupees or 200, I don't think it matters. So I think partly it is because of that, inelasticity of the price to demand and necessity of the demand. Soon it is expected to get the cash flows, free cash flows and high dividend yield kind of thing. So it's a little bit more forward looking, but industry is well placed, and that's the reason. I think industry, there's overweight in that. We used to own it. We recently sold it because we found a little bit of stretch valuation. But we might buy it again. This was more kind of, we found something else from a risk reward perspective. And that was the more our reason of selling rather than we becoming negative on Bharti per se. So again, we have to allocate capital within the limited pool of capital. But generally speaking, the business is good in a duopoly situation. It's always a good situation.
Sure, we are kind of moving on to our concluding questions. And the question that comes to my mind is that your success at Carnelian, I think, primarily has been in identifying, what is going to work tomorrow and then focusing on that. So from that point of view, are you wanting to focus on what you have in hand, or you are thinking of launching something new also? You see any new trend emerging? You see anything, which could create more wealth and is reasonably placed today, is a contrarian approach, like you were able to pick out shift strategy in 2020?
So I think, see, look again, trends are always around the corner. As an investor, you have to keep your eyes on, here and future, right? You can't ignore either, and that is where the massive wealth is, opportunities are being created. But what we are doing is, so right now we are not creating a new product. Manufacturing and technology is a decadal trend where we are focusing on. But whatever, many themes which we see, we try to play through our bespoke strategy, through our compounder strategy. That is our approach right now, and we think that will play out. So we are not launching any new product within the existing product. Only we'll keep focusing. Of course, we'll be launching one open-ended AIF, which will be flexi cap based on whatever trends which we see. That will be coming out in about a month's time. But other than that, we will be continuing to focus on our current products.
Sure. If you were to kind of, give your viewpoint on allocating between India and any other market, it could be China, it could be US, it could be UK. How will you allocate if it was your money, or if you were to maybe talk about your personal asset allocation between India and overseas? Maybe that could give conviction in terms of your kind of favoritism towards India versus any other market.
100 and 0. I have been, long believer of that. I know there was 3 years ago, there was a big, trend which people had started investing into China market. And I used to say that, when you have, ghar ki murgi dal barabar, when you have the best market at home, which you understand, best growth going up, why to went and look elsewhere where you have to seek information, you have to understand, whereas, your best growth profile is happening in front of you and under your eyes. So I am 100% invested into equities here, and this I actively advise to people to look at India as a market. Because of all the factors which we outlined, risk premiums are going down. In my opinion, even dollar, historically we all have believed that rupee will depreciate 5-6% every year. I think gone are the days. I don't think rupee will depreciate. That was a very big reason for people to invest abroad. In my opinion, that is history. Given where we are moving from current account deficit to current account surplus over next 5-7 years, I think we are in a sweet spot where rupee also will hold on, and the additional return, additional comfort of investing into dollar assets also reason is going away. So I would say 100-0.
Because I think I'll give the concluding remarks. This has been really insightful webinar and a kind of a, I would say, reminder to all the savvy investors for whom we have started this initiative in 2019 to do weekly webinars, because it is important to hold our emotions it's during the times of greed as well as during the time of fear. These are times of cheer and maybe not greed. And being fearful is kind of not right. Being cautious is right. And hence, one needs to be cautious in terms of taking informed decisions. And that's where we help our clients, our investors, make decisions on the basis of data. We are not who are kind of driven by brands, who are driven by larger AUMs. We have identified some of the finest fund managers based on our objective evaluation of their portfolio construct in terms of statistics like beta, alpha, information ratio, many such factors, which to many people in this industry are even kind of those numbers which people do not even look at. People just go by stories, and we do not go by stories. And then, if any fund manager is kind of throwing any argument, we try to deep dive that argument, which is what has given us success, because we try to handhold investor to actually be with him in his journey of wealth creation. We are selling the dream of wealth creation, and then if you are unable to deliver that dream, it is something which doesn't satisfy us, and we know this is a dream which requires a long term horizon. And during that long term horizon, there are times of cheers, times of fears, times of greed, and hence this ongoing activity on trying to address all these questions goes on. And obviously, I'm really thankful to fund managers like you who understand our initiative and who give us time, your precious time, to kind of discuss all these concerns as and when they are pressing. And hence, thank you so much today to join us for this webinar, and thank you everyone for joining. Thank you everyone.
Thank you, Kamal. Thank you for having me. Appreciate you having me and curating this platform.